It doesn't matter if you're in your 20s or your 70s. There are always things you should be doing in order to achieve financial success.
Today, we're going to talk about the top things that you should plan for in each decade of your life. I'm Alex Sunners. I'm joined by my colleague here, Jackson Courtney, and today we're going to talk about all of the financial planning you should do in every decade of your life. So we'll start with your 20s, and your 20s is an exciting time. You're fresh out of college, you're getting started with your career, and it's the best time to start thinking about, all right, let's set myself up for financial success in the future. And one of the first things you should do is just create a basic budget. Track your expenses, track your income. Just make sure that you're not overspending or underspending on certain areas. It's very important you just get a good handle on what you're spending each month. And within that budget, you can say, okay, let's set aside X amount of dollars to start an emergency fund. And that emergency fund is just cash savings, 3 to 6 months worth of your typical expenses, so that if you lose your job, a car repair comes up, you have this liquid cash available on the sidelines. It's also important that you get invested early, start investing. The power of compounding is enormous. The earlier you can start investing for your retirement, the better. So a powerful tool you can start is a Roth IRA. A Roth IRA in 2025, you can do $7,000 each year. And within that Roth IRA, you can then invest the money in stocks, bonds, mutual funds, etc. While you're in your 20s, you'll likely want to be invested more aggressively because that money has time to grow before you're retired. Another option is invest in your company 401k, especially if your company offers a company match. So that means if, let's say, you put in 5%, they match that 5% 100%. So you're basically getting extra money in your 401k without having to put extra of your own money into that 401k. And then another thing in your 20s that you should be focused on is paying down any high interest debt first, and then focusing on your other debts as you have the income to do so. So things like credit cards, you want to make sure you're not accumulating any credit card debt, and if you have already, pay those down as aggressively as possible. And then start focusing on things like student loans if you have them, if you have a car loan outstanding, trying to pay down your debts as fast as you can.
Yeah, those are all great points, Alec. I mean, paying down the high interest debt really is what we see to be most beneficial for our young clients. So, like Alex said, once you're in your 20s, you're starting to work full time, and then eventually, you hit your 30s, and you're starting to really kind of find your lane in your career. You're starting to do things like increase your retirement contributions. A lot of plans even have an option to automatically increase your contributions by 1% each year. And that can really help. It's like you're not even thinking about it. The plan just keeps going on and you keep contributing more, which, it helps you build away that nest egg for retirement.
Yeah, and one thing that you could do is, I like to say, when you get a raise, pay yourself second. So
Yep.
Put that money first into your 401k, take maybe half your raise and increase your 401k contribution with it, and then take that other half and then you can use that for your own lifestyle. But by putting that money into the 401k before you even see that first paycheck can be very powerful.
Exactly right. And really, it's just like you touched on, the art of compounding interest. If you can increase your retirement contributions early on, then the compounding effect is just massive in the long run. The next thing you can do is, as you're in your 30s, a lot of people start to have kids and get married. You can start saving for your kids' education and get potential tax breaks on it. We like to do this through the Maryland 529 plan. It's different for each state, but in Maryland, they have a 529 plan, and you get a tax deduction for making contributions and using the plan. So why not see that benefit as you start to save for your kids' education? It's another thing like retirement contributions. You do it on an automatic percentage basis,
Yep.
and you just defer money, whether it's $50, $100 a paycheck, whatever it is. 18 years go by and your kid wants to go to college, then you have that money saved up and you've been investing for almost 20 years.
Yep.
Another thing we like to think about is ways that we can start mitigating risk. And that can really be through life insurance. We typically, we don't sell product, but typically if you're in your 30s, you might have a mortgage, you might have a large expenditure coming up like college. or private high school, for example. And for you and your spouse, you're going to want to think about maybe adding some form of life insurance. There's kind of two directions you can go: whole life or term. One's cheaper than the other, but they each have their benefits. So that might be something that you consider as well.
Yep.
Another big thing at this stage in your life is building good credit. So how can we build good credit? They look at kind of three main things, and that's the length of your credit history, the amount of your credit usage, and the amounts that you're carrying in interest. And really, as you build credit, you just want to make sure that you're leaving things open, leaving lines open, but also making sure you're paying it down each month. Like Alex said, in your 20s, you want to make sure that you're not leaving your high yield, your high interest debt outstanding. And then kind of in line with that is starting to consider home ownership, where you're doing family planning and you're thinking about having a home and maybe just not renting. Ways that you can plan for that is just like you said, getting back to budgeting. Having money set aside each month to really figure out how much you can afford in a mortgage, or along those lines. So that's really the things that we focus on in your 30s.
Yeah, there's a lot of differences between renting versus buying, and every situation is different. But home ownership can be a very powerful investment vehicle, because when you're paying that mortgage, instead of when you pay rent, that money's just gone.
Right.
When you pay the mortgage, you're paying the principal down on that residence, and you're getting equity in that home.
Exactly.
So now that you're past your 30s, you're into your 40s, now what you should be doing? Well, now that you're pretty far into your career, you might have had a couple promotions, a couple raises. At this point, you should be maxing out your retirement accounts. So that includes your 401k or 403b, 457, depending on what type of company you work for, as well as a Roth IRA or traditional IRA, depending on your income level. Those things can vary person to person, but you really should be putting as much as possible into these retirement accounts, so that when you're 67 years old, you're not saying, oh, I have to wait another 5 years to retire because I didn't save as much as I could when I was younger. So really want to make sure you're maxing out those retirement plans.
Right.
Now that you're also in your 40s, it'd be a good time to update estate documents. Typically, people will get their sort of first, last will and testament when they have kids. It's an important one to do, because when you have kids, you want to say, okay, I want this person to be their guardian if we were to ever pass away. But typically when people do that, that's the only thing they do with their will, and that's sort of, they say, okay, we're done. So now that you're into your 40s, you have some assets accumulated, take a good look at your wills. Maybe if you're confident in your spouse with that trust, a power of attorney might make sense. Make sure you have your advance directive updated. These are all things that you should be thinking about as you're in your 40s. Also, when you're into your 40s, you might think, okay, now's the time to start looking at our investments a little bit closer. In your 20s and 30s, typically most people are 100% in equities. Mm-hmm. They're younger, their time horizon is longer, so you can afford to take all of that risk. Now that you're in your 40s, you have to say, okay, what are my goals with this money? Is this money my long-term retirement plan? Or have you started accumulating money in an after-tax account that you say, well, actually, you want to buy a second home? Well, if you're trying to buy a second home within the next couple of years, that money probably shouldn't be invested 100% in equities anymore. So now is the time to start looking at those investments and saying, okay, what sort of risk can I take? How do I optimize what I'm invested in? Now that you're also in your 40s, your parents are probably getting up there in age as well. And now would be a good time to start preparing for aging parents. And do they have a plan themselves for, are they gonna stay in their home? Are they gonna move into a retirement community? Are they gonna need skilled nursing home, et cetera, et cetera? Now is the time to start preparing for that before the event happens that your parents now need something immediately and you don't have a plan in place. So having that plan in place now is really important. And then also in your 40s, we see this a lot with a lot of clients, is people have lifestyle creep, and they get those promotions, they get those raises, and all of a sudden their spending goes up with it and their savings does not. And it's important to make sure you don't just say, oh, my next raise, I'll bump up my 401k. I really need this money to do X, Y, and Z. It's important that as your income goes up, your spending doesn't go up in a directional line with that, and that you're still allocating enough to savings.
Exactly right. And it all gets back to what you started with, budgeting and paying yourself second.
Yep.
As you start to make more money, you really want to put away more money first before you consider, things like, oh, I can buy a new car and I can take on another mortgage, or, things like that.
Yeah.
Really paying yourself second, I think that's a great point. And after your 40s, of course, you start to roll into your 50s. And what happens? Well, you can now put even more money into your retirement plans. You can get your catch-up contribution, which to your 401k this year is an extra $7,500. And then to IRAs, it's an extra $1,000. So depending on what your tax bracket is and what IRA or 401k you want to use, potentially, almost $10,000 more that you can put away into your retirement accounts every single year as you get into your 50s. And this can be really, really important. Those last years before you retire, you really want to stuff those retirement plans as much as you can. And also, this is really the age where people start to think about retirement.
Yeah.
Social Security is starting to come up. They have the ability to claim at age 62, and longer. And this is really where we start to focus with clients on their retirement income and expenses. It's kind of like building blocks. You start in your 20s, you start with budgeting, and then as you get to your 50s, you're still working on your budgeting, and you're just projecting it out further to see how it's going to last you until, unfortunately, end of life. But it's very important that you figure out what your retirement expenses are going to be, and then what your retirement income is going to be. And it's considering things like your pension, your Social Security, income from your retirement accounts or your taxable accounts, and kind of putting all those into the folds of tax planning. They're all really important to consider. The other thing is considering long-term care insurance. We've seen clients that past 50, it starts to become harder to even get approved to have long-term care insurance.
And if you do, the prices are just astronomical, where it doesn't even make sense for you to pay those premiums if you get it too late.
Exactly. It's not even financially, reasonable to do. So really start to consider long-term care insurance really before your 50s, but early 50s is when we typically start to recommend that people consider a policy.
And we've seen we need to start recommending this earlier and earlier and earlier.
Yep.
Because the prices have gotten higher and higher and higher for long-term care insurance.
Right. I mean, the inflation on the long-term care itself that eventually will potentially have a need, the inflation on it has been quite high. So having that insurance, whether it might not even be fully insuring, but maybe halfway insuring something that can really help in the long run. And the last thing that we think about in the 50s is try to pay off any debt remaining. At this point, the debt can we've seen interest rates now 7 or 8% on certain debts. We really don't want our clients to be paying 7 or 8% as we're trying to save for retirement.
Yeah.
Those last years, that debt just keeps eating away at their investment returns, and really can kind of dampen the long-term plan.
Yeah, and we'll see a lot of times people in their 50s will take out student loans for their kids to go to college. And this goes back to those building blocks we mentioned earlier. If you don't start saving for your child's education early, and then they get to 18 years old and they say, okay, I want to go to college, mom and dad, and you don't have those savings, we see people take out loans. And that's something we really want to try and avoid, having to pay student loans while you're retired.
Mm-hmm. Exactly right.
So now that you're into your 60s, what should you be focused on? And I think the number one answer is retirement. This is the time where most people say, I would like to retire. And that's going to vary person to person. One, if you like what you're doing, you shouldn't just say, okay, here's the age I said to retire, I'm going to retire. If you enjoy working, keep working. But if you say, yep, I put my time in, these are my expenses, this is my income, let's talk about retirement. And one of the first things that we want to talk about is that Social Security strategy. When is the best time to take Social Security? And you've likely heard us say this before, but Social Security is not this black box that you don't know the best time to do it and start your benefits and your spouse benefits, et cetera, et cetera. The big emphasis with the Social Security is just longevity. If you can plan for when you're going to pass away, you can plan perfectly for when to take Social Security. Obviously, we don't know when we're going to pass away, but you can look at family history, you can look at data about other seniors and what the expected life expectancy is, and say, let's try and optimize our Social Security strategy so that we are taking it at the appropriate times. A lot of times people will take it too early because they want to take that benefit and just receive that income, but that can be a detriment if you're living longer. It can really dampen the amount of income you're getting throughout your lifetime. So want to make sure you have that Social Security strategy finalized, and you also want to finalize those last retirement plans of, okay, we've done the analysis, we need this amount in income, we have this amount in expenses, what should our final retirement plans be? And then even when you make those final plans, that doesn't mean you say, okay, I'm 60, I'm planning on retiring at 65, I'll see you in 5 years. You want to make sure you're reviewing that plan each and every year to make sure things haven't changed within that plan.
Right.
And you want to make sure you're also reviewing those retirement withdrawal strategies. There are different tax buckets you've likely saved in throughout your lifetime. You have pre-tax 401k, you have after-tax brokerage accounts, you might have Roth IRA or Roth 401k. So you want to make sure you optimize where you're taking that money from in retirement. And we have tons of videos on our channel about the different strategies you can use to make sure you're not paying too much in taxes in retirement.
Right.
And then the last thing you should be doing in your 60s, besides just thinking about retirement, is considering Roth conversions. A Roth conversion is when you take money from a pre-tax IRA, take it out and convert it into a Roth IRA. That creates taxable income, but there's typically a couple years there where you can really optimize the amount of money you're putting into Roth without paying too much in taxes. And it's typically between the ages that you retire and before you start collecting your required minimum distributions, or even before you start collecting Social Security. It's going to depend. You really should be doing a tax analysis to make sure that you are reviewing these Roth conversions.
Yeah, and I think that's a great segue into your 70s, Alec, because of course, we've had clients who have started taking their required minimum distributions, or RMDs as they're known, at age 72. Now it's age 73, and eventually it'll move to age 75. But as you start taking these RMDs, all that money has to be taxed at your ordinary income tax bracket.
Yeah.
And as you're claiming Social Security and you have an income, and then you could potentially have another pension, which is more income, and then you have the RMD, which is a third level of income, and you could potentially be in a much higher tax bracket than where you were even when you were working.
Yeah.
So it's just like we talked about, getting back to the building blocks. If you start to have those buckets early where you have something like a Roth IRA, Roth IRAs do not have RMDs. So you do not have to pull out from them at a certain age to start paying tax on it. In fact, the money's tax-free when you pull it out. So building in that Roth bucket, I think, is really important. The other thing that we really want to focus on is a good estate plan. You want to have it set up when you have kids and things, but at this age, like Alex said, we don't know what's going to happen, unfortunately. We want to have our estate plan set up so that it doesn't come back to bite us later if we're not prepared. This is, again, making sure that your will is set up to your wishes, making sure your advance directive is set up so that you have your healthcare agent who will make decisions for you in the situation that you're incapacitated, and then having your power of attorney set up to basically do the same thing but for financial decisions. The interesting thing, though, is while we want those estate documents, the biggest two things that we can do for an estate plan is titling and beneficiaries.
Yeah.
Assets will pass by the title of the account and the beneficiaries of the account before they even look at the will. So it's extremely important that every time you come in to review with us your plan, that we look at what your beneficiary designations are. We make sure that the titling of the accounts is correct, and then if you haven't, then we definitely recommend that you kind of audit your financial accounts, especially things like your 401k, to make sure that your beneficiaries line up with your wishes. Also, in your 70s, Alec talked about different retirement income strategies. This is really where we want to simplify and optimize your investments. We want to figure out how much income you need in retirement and how we should allocate, because if we need income, then we shouldn't be 100% in stocks.
Yeah.
And if we need, if we need to mitigate risk more, then again, we shouldn't be 100% in stocks. We need to have that nest egg for your retirement for you to draw off of. So it's a really good time to optimize your investment plan. The other thing with estate planning is discuss the aging care with your family. You prepare them to say, here's where all my documents are, or this is my financial advisor. This is who you would get in contact with, and start to think about who you would want to be your power of attorney, and who you'd want to make financial decisions for you.
Like you hopefully did in your 40s for your own parents, now you should be doing for your own kids or other family members that could be taking care of you as you get older.
Exactly right. The other interesting thing is you're in your 70s, even before you start to take RMDs, you can take what's called a qualified charitable distribution, or a QCD. And this is really what we've seen optimize our tax plans for our clients that are charitably inclined. And really what a QCD does is it decreases dollar for dollar what you have to take out as an RMD. So let's say, I'm 75, I'm charitably inclined, and my first RMD is $20,000, let's say, and I want to donate $10,000 to charity. Then I can take that $10,000 out of my IRA as a QCD, and it'll directly decrease what my RMD was from $20,000 down to $10,000. So it's essentially a tax efficient way of giving money to charity if that is what you're inclined to do.
You're taking pre-tax money and turning it into tax-free money.
Exactly right. The last thing that we think about in the 70s is to regularly review your retirement income and expenses. You want to make sure that, like we talked about, that your portfolio is set up how you want it, that you're able to sleep at night, with your investments, and making sure that your expenses, again, making sure your budget isn't out of control. Especially as we age and we have things like long-term care come up, it's really important to come and talk to us about what your budget looks like for that, what your expenses and how your income balances it out.
Yeah, and I think beyond your 70s, a lot of it looks like your 70s. You're just making sure you're on top of things like your estate plan, still reviewing your retirement plan so that your income and expenses are similar to what we had planned for. And you're just looking at things like healthcare and aging. That's the big thing after you get past 70 is healthcare expenses are going to be up, and you really want to make sure you have a good aging plan. Yeah. So whether you're 25 or 75, this impacts everyone. There's always different things that you should be thinking about. And if you have any questions about, one, anything we went through, or two, other things that we might not have covered that you were thinking about, if you're already a client, you can either reach out to myself or Jackson, or you can reach out to your primary advisor. If you're not already a client, we'll put a QR code up on the screen that you can scan and schedule an intro call with us, where we'll discuss who we are and what we do. Thank you everyone for watching, and we'll see you in the next one.
Thanks everyone.